Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Long Verticals and Diagonals. And today we're taking a little bit of a different approach. We're going to be talking through what I would call a beginner's guide to trading vertical spreads in a small account. And interestingly enough, we have my very good friend Barb Armstrong here to help me out with this discussion. She teaches a regular webcast series called Trading a Smaller Account. So I'm going to give you a link to that in a little bit. But this is going to be one of those webcasts that, yes, it's maybe targeted toward those that are managing a relatively smaller portfolio. But even for those with larger portfolios, I think quite commonly, we might set aside a smaller amount of cash with which we tend to be a little bit more maybe adventurous, maybe a little bit more aggressive. So this could suit either of those two sorts of portfolios. Should be an interesting discussion. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see many familiar names, as it always is. Hello there, Josh and Mighty Mouse and Will, Ricebird, Andrew, Rick, Vic, Life in the Fast Lane. Everybody else, thanks for joining us week after week. We always do appreciate your attendance, your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Thursday webcast series. We kick things off promptly at 11 Eastern time. If you'd like to join us, it'd be great to have you in our live audience. And as I've already mentioned, as a treat for our live audience members, my very good friend, Barb Armstrong, is joining us in the chats. She's just going to be addressing any questions that I can't get to during the flow of the presentation. Thanks for having my back there, Barb. And Barb and I also can be the best place to connect with us in between these live streams is to follow us on X. So you can follow Barb there at Barb Armstrong CS. You can follow me on X at Cameron May CS. But let's get into this discussion of trading vertical spreads in a smaller account, or maybe just with the smaller portion of one's larger portfolio. All right, now, as we do, of course, there are risks associated with this strategy, so we need to be aware of risks. Disclosures are important, so bear this in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's set the agenda for what we're going to be covering today. This webcast, this video is part of an ongoing series. So the very first thing that we're going to do is a quick recap of existing positions. We're not going to be making any changes to existing positions, but there have been two trades that concluded between the last webcast and this one. So I want to give you a quick revisit of that. Once we've done that, though, we're going to take a peek at the S&P 500 to see the sorts of conditions under which a trader might be trading vertical spreads at this moment. But then we're going to dedicate the rest of our discussion to weighing the pros and the cons, some of the important considerations of trading vertical spreads in a smaller account. All right. So let's go right to the Thinkorswim platform, have a quick look at our existing positions. You know, last week when we left off, we had 4. Now we're down to 2. So let's look at the existing 2 first. I'll show you what happened to the other 2. But first of all, we have Gilead Sciences. This is a long call diagonal spread. We own the 17th of June, $95 call for 2027, expiring in 651 days. We want the stock to just go up as far as it can to help out that long call. But at the same time, we've sold the 17th of October 120 short call. So the preference there is for the stock to actually still be below 120 through the 17th of October. And this is actually just the latest in a series of short options that we've sold against that long in that diagonal spread trade. We purchased the original long call way back here in January, and you see the stock has gone up nicely, you know, sort of through a series of highs and lows. But that's helped out that long call, and it is right now highly profitable. Along the way, we've sold how many now? 1, 2, 3, 4, 5, 6, 7, 8, 9 short calls. So far, 6 for profit, 2 for a loss, 1 is TBD. But this is where we find ourselves right now. You can see the stock is well below our short strike. might be bouncing along an upward trend line. We'll see if it can go up, which would be great for the long call, but stay below that 120 short. We're going to let that one continue to work. So that's that diagonal spread. Our Alphabet position is very similar, not quite the extensive history of our Gilead, but let's bring up Alphabet. This one's very interesting, though. Let me, let's see, did we have another trade up here? Nope, just that one right there. We reset that y-axis. In any case, bought the long call here, bought the 180 long call, sold initially a 205 short call, and that thing was teasing right there, getting up to expiration, close to being in the money at expiration. Even an out of the money contract can be assigned. But this one, we closed it out just in case for just a small profit. Sold another one up here at 215. Now, it's great that the stock has had a nice gap up for our long option. Long option is doing great, but that short option is now deeply in the money. 215 short call. The stock's at 227.5, $12.50 in the money. Now, in paper money, there's no risk of early assignment. But in real life, when we go that deeply in the money, it can elevate that risk of early assignment. I'm going to let this one go. Again, no risk of early assignment in a paper money. What the trader might be hoping for maybe for an exit on the short option is to see this pull back. That might allow us to buy out for maybe less than it's trading for at the moment. We'll see. But I did want to quickly just give a minute or two to what might the trader do if they're in this position and the short call does get assigned. Uh-oh. Somebody just bought the shares from us for 215. We would be short shares of Alphabet if we did that, or if that happened. So what might the trader do there? Short the shares. Oh, wait a minute. We have the right to buy those shares down here at 180. Awesome. Buy them at 180. They've been sold for 215. That'd be a $35 realized profit on the stock trade. That's probably not the best course of action, though. Why not? Well, here's why. When we go back to our monitor tab, that 180 call is worth $53, 52.5. To assign it would be giving us, yes, a pretty steep discount. The shares are worth 227 right now. It would be giving us, what is that, a $47 discount on the stock, but costing us $52 of value to do that. We'd be leaving $5 of value on the table. Generally, in this scenario, what the best course of action mathematically for the trader is to, if they get assigned and they wind up short the shares, buy the shares on the open market and either retain the long call or sell it for its current value. That would be a mathematically superior exit. All right. I wanted to talk through that, but that's the value of having these sorts of trades on in practice. We can talk through the management of these sorts of things. In any case, we're going to let that one continue to go. It's not going to get assigned. I know that because it's a paper trade. But we do have two other positions. So let's look at those. First trade was, well, let's do last week's trade last. So let's do Apple. Here's what's happened with Apple. Apple, we owned the 225 long call, or 222.5, sold the 225. That's a long call vertical spread, and which is bullish, and the stock just went shooting up. Well, we actually had a trade in, we had an order in to close out that trade if we could do it with 80% of the original maximum gain on the trade. And that's exactly what's happened there. So if we go to our account statement and we look at the trade history of Apple, here's the original purchase of that debit spread, $1.55. Sold that for $2.30. So that's what, a 75-cent profit on a 155 investment, close to 50% return. Not bad. That's actually the second time we've done this. Smaller profit the first time. Bought it for 165, sold it for 210. Maybe we'll come back and do this again, but we're done with Apple. We're also done with last week's trade, but for a very different reason. Here's MasterCard. This is going to sound dramatic. Here we own the 585. We owned the 585 long call, sold the 590. Our preference is to be up here. Well, if you look at the activity on the 2nd, so today's the 4th, on the 2nd, there was a lot of volatility in the morning. The stock shot down and then shot right back up. And what that did is we had a stop in place. It was to trigger if the value of our investment fell by 50% or more. Well, guess what happened? The stock actually shot down and triggered that. That fired off a market order. But by the time that order was filled, the stock had actually recovered to a dramatic extent, and we actually made a profit. Never happened before in these webcasts, in my experience, but it did this time. All right. It's one of the weird possibilities here. But what happened here, let me bring up the history here. Let's see. So that was MA. There we are. So we bought in for a 315 debit. You'll notice our stop was hit for a 335 credit. That's a 20-cent profit, and it's because of that volatility. So when we say that a stop price is not guaranteed, a stop price is not guaranteed. Sometimes we take a bigger loss than expected. Sometimes it's a smaller loss than expected. And every once in a blue moon, I guess, make a profit. Yep, that's what happened there. We got lucky. I didn't plan it that way. It's just the way it worked out. Anyway, so those are our existing positions. That's what happened with our recent trades. Let's move on to today's discussion. And we're going to be planning and placing a long call vertical spread, just as a spoiler alert. But we're going to talk about how that may suit a smaller portfolio, how it might be tailored to a smaller portfolio. Certainly carries risk. This is not a sales pitch for an approach, but we're going to weigh the pros and the cons. And to set the stage for that, let's look at what's going on with the S&P 500. S&P is having another good day, up about 0.25%. We've been rallying sharply since those April lows, and we're teasing right up there near all-time highs. And let's just say that our hypothetical trader out there, maybe they're managing their small portfolio, trying to nurse it along, hopefully helping it grow, or maybe it's a larger portfolio and they have a smaller pile of cash and are trying to grow that pile more aggressively while taking larger risks. Well, in any case, as they're doing that, let's say that our trader has the outlook as maybe they're planning, should we go out? Let's go out here more toward that October expiration for our next trade. So maybe the trader's looking out on that time horizon. Let's say their conviction is markets have momentum. Maybe they think we're more likely to go up than down from here. So we're going to be doing a bullish trade example. Not a guarantee that that's exactly what the markets are going to do, but that's how we're going to structure today's trade. So let's talk about vertical spreads and why for some traders it can be sort of a go-to strategy in a smaller portfolio or that smaller, more adventurous portion of their portfolio. And it's because it has a few theoretical advantages over other options, other similar option strategies. So how about we bring up an example stock? I'm going to use Walmart for today's example, and I want to talk. No, sorry. So I'm going to use Walmart. I thought I was going to use something else. Anyway, we'll come back to that. In any case, there are some potential advantages for that smaller account of vertical spreads versus, let's say, just buying a long call or buying a long option or just selling a short option. When compared to just buying long options, it can have, and especially if we're just using the same or similar strikes, there can be a lower cost. There's also a defined risk element. There's a maximum theoretical gain, a maximum theoretical loss to the trade, and that can be attractive for those that are trying to manage a smaller portfolio in a very measured way. Now, when we compare that to a short option, short options can have lots of risk exposure and a very large margin requirement. It can tie up a lot of cash. And in a small account, cash is in scarce supply, and so that can be a potential benefit. Now, there are some important considerations here as the trader goes to structure a vertical spread. Some of the things that a trader might focus on is liquidity. When we're trading options, liquidity can be a big deal. Let's go to our scan tab and let's maybe start to build a scan for stocks exhibiting characteristics that may be important to a smaller account for the construction of a vertical spread, right? But liquidity and price are common important considerations. So how about as we go to our scan, I'm just starting with a fresh scan. If you have any previous scans that are still sort of cluttering things up here, you can go up here to the upper right and just click reset. It'll ask you, are you sure you want to do that? I'm going to click yes. And that just gives us this sort of blank slate. And how about for our very first scan criteria, let's set a specific price per share, because options are contracts between traders to maybe exchange shares of stock. And if they're contracts where we're agreeing to exchange highly expensive shares of stock, that might not be entirely appropriate for a smaller account. So how about for our first stock criteria, let's go to the mark or the market value of the stock, and let's set a minimum of, what should we say? Maybe $40? How about a maximum of 200? I think we can understand why I'm putting a maximum in here. We're trying to reduce the contract parameters for us to fit into a smaller portfolio, so a lower price per share can make sense. Why not just go even lower with the price per share? Those sorts of stocks, first of all, very low price stocks tend to be more volatile. It can introduce more risk. They also will tend to have wider spreads between the bid price and the ask price of their options. That can lead to issues with pricing and with trading. Also, there just aren't very many choices when we look at the options chain. There are just not very many available strike prices. So how about we just set our minimum here? For that logic or for any number of other reasons, let's just go for a range between $40 and $200. Next up is going to be an emphasis on liquidity. And a big way to address liquidity, we're going to address it sort of generally and then very specifically. One way is to make sure that the trader is trading very large companies that are trading millions of shares on a regular basis. How about we choose a market capitalization? And we could go with a small cap stock, maybe a couple of $1 billion. We could go with a mid cap stock, maybe up to a couple of $1 billion. Mid cap stocks up to maybe $10 billion in value. I'm going to go way beyond that. Let's say that our small account trader wants $100 billion companies or larger. Okay. So we're trading stocks that are priced between $40 and $200 per share, or contracts on those stocks on very large companies, which is hopefully a step toward not entirely ensuring liquidity, but a stronger probability of liquidity. But let's address that liquidity issue more directly. We're just going to make a volume requirement here. So when we're running a scan for volume, this is going to scan for whatever the stock's trading volume is today. So if we were to run this scan the very first thing in the morning, nobody has any volume yet. But even if we let's put in 1 million shares. The most heavily traded companies will get 1 million shares of volume just almost immediately as the markets open. So I'm going to set that as a floor requirement. And that's going to be our scan for today. So we're looking for stocks on which we're going to be constructing a vertical spread. Price between $40 and $200. They are $100 billion companies or larger, and they have at least 1 million shares traded already today. And as of the recording of this webcast, we're not even 2 hours into trading. And let's click scan and let's see how many companies we have. And it looks like we have 40. Okay, so out of all of the great big companies out there, there are only 40. I think some of you might be surprised with the stocks having gone up and up and up in value. You might have been surprised that there are even 40 great big companies that are still priced between $40 and $200 per share. So let me scan down through here. I'm trying to trip my own memory because Walmart will work just fine. Let me do this. I'm going to click on the, let's go to the last price here. And I'm going to order these by price per share. How about we look at one around that $50 range? I think Bank of America. Let's look at that. Tatiana says, I only have 4 Tatiana, I don't know what you might have done differently on yours than on mine. All it takes is one little click that's different, and I don't know which click it is, but one thing that's very common when running a scan is you'll notice I scanned in all stocks. If you scanned yours just to like a watch list or just to like, I don't know, the S&P 100, something like that, you will get a smaller list. So just make sure that we're scanning in all stocks. That could be it. I don't know for sure though. All right, but let's go have a look at the chart of Bank of America. All right, so here you'll notice recently, this is a drawing I made some time ago, but Bank of America to a technical trader might have been coming up pushing against a price ceiling around that $49.50 mark. Very recently broke up and through, and it's kind of pulled back down and is bouncing off that level. Now I chose the $50 range because in that small account, if we're trading options, we are again agreeing to potentially buy or sell shares of stock. And this is agreeing to buy or sell shares that are in the $50 range. There are shares out there that are in the hundreds or thousands of dollars. And if we're doing that times 100, you can see how that can get outside the scope of a small account very quickly. So that's why we've chosen this sort of lower price stock. Still, it's Bank of America, one of the most liquid companies in the world, one of the most heavily traded companies in the world. And when a stock is highly liquid, its options are also going to tend to fall on the higher end of the liquidity scale most of the time. So let's say that our trader sees, all right, we've pulled back down to about that 49.5 level. We've already popped up. We're at about 50.25 now. And maybe they think that for the next few weeks, the stock is more likely to go up than down. Okay, well, that suits the bullish outlook that maybe we concluded from our review of the markets. But I wanted to hit on some other considerations that the trader might have in mind as they're constructing this vertical spread. Yes, liquidity. Yes, price per share can be important, but also if the trader is attempting to avoid complications of this trade, there are a few things they may want to look to avoid. Number one is earnings announcements. Look what's happening right before this October 17th expiration. There's an earnings announcement. Now, our trade could succeed or fail on its own merits, obviously, but this earnings announcement can just come and throw in, even if a trade is working out, it can throw a kink in the works, cause this thing to reverse. Maybe some traders just prefer to avoid that event. So let's just say we're going to construct our trade so that it's concluded before this earnings announcement, which looks like it's scheduled for the 15th of October. All right. Another thing that the trader might want to avoid to try to sidestep potential complications is just expiration. If we have a small portfolio and we allow a contract that is in the money to get to expiration, well, it's going to be assigned or it's going to be exercised. And if only one is in the money at expiration, that can change the scenario dramatically. If, let's say, just our long option is in the money, our long call is in the money, we might wind up buying some shares and committing more cash to this trade than the trader ever intended to. Typically, with these smaller portfolios, the trader's objective is to get in and out before expiration, before exercise, before assignment. So avoiding earnings, avoiding expiration, avoiding exercising, assignment, all of those things may help us sidestep some additional potential complications, additional potential expenses down the line for this trade. All right. Now, a couple of final things as we structure our trade. We're just going to do one contract. We're going to make this as small as possible. And then we're going to practice. So our small portfolio trader might build some confidence before actually venturing out into the world of real risk. All right. But how about we build this trade? And I want to talk through, as we build it, why some do consider it to be suitable for a small portfolio. Now, I always say some because not everybody trades these strategies. But I'm going to go to the trade tab. And we know, what was the date of that expiration, or pardon me, that earnings announcement? That was on the 15th. So Bank of America, because it's one of those big liquid companies, also offers weekly contracts. And it looks like there is one that expires right there on the 10th of October. That's just about a solid week, 5 days before earnings. Earnings are not a concern. They can still influence price, not directly, but before the event. But let's trade the 10th of October here. And I'm going to go down here. And how about we structure with a stock around 50? I'm going to structure a high probability trade. And by high probability, I just mean it has a better than 50-50 chance of accomplishing its maximum gain if we were to allow this to go all the way to expiration. But we're even going to put in an order to try to get out at a good portion of that maximum gain. But here's going to be our trade. Get rid of this previous information from a previous webcast. We're going to do an example trade, which is going to be a long call spread. I'm just going to be trying to minimize the cost, just in the interests of the theme of today's discussion, as much as possible. We're going to enter this long call spread. Here's how it's going to be constructed. We're going to buy the 10th of October, $49 call. It looks like that's going to trade. That's trading right now between 211 and 215. Let's call it for 213 in the middle. And at the same time, we're going to sell the 10th of October, $50 call. That looks like that's trading between 149 and 152. Let's just use the round number 150. So that's going to leave us a net cost for this trade, $213 spent, $1.50 collected. Our net debit, which is also the theoretical max loss of this trade, is going to be 63 cents per share, or on 100 shares, $63. So is this a highly expensive trade? No. Does it have some limited upside potential as well? Yes, it certainly does. However, just because it has limited upside potential doesn't mean that it's a small upside potential. It's actually, as a percentage, a quite high potential for reward. What's the most the trader can make on this trade? If this is how much we can lose, how much can the trader make? The theoretical maximum gain of this trade is going to be the 63 cent well, it's going to be $1 minus the 63 cent investment. So it's going to leave us with 37 cents or $37. So if we're investing $63 and we stand to make 37 if the trade goes well, I mean, what kind of a return is that? Let's go up to our calculator. $37 earned on a $63 investment is a 59% potential return. That is a very high return potential, but certainly risk associated with this trade. So let's talk through that. I think you can see why this might fit. Now, fit and suitability are two different things. It could be affordable in a small portfolio. That's one thing. But is it suitable for everybody? I'm not making that claim in the slightest, because not every trader is going to be comfortable with this strategy. We have to weigh the pros and the cons. And even if it fits in a portfolio, it doesn't mean it's going to be suitable for every portfolio. So Scott, here's where that $1 comes from. Okay. So what we've done here is entered into two contracts. We spent $2.13 per share to enter into a contract where we have the right to buy 100 shares of stock for $49 per share. That's the deal of this first contract. Through the 10th of October, at any time, we have the right to buy shares for $49. But at the same time, we entered into a second contract for which we were paid $1.50, but we took upon ourselves the obligation. Someone has the right to buy shares from us for $50 per share. So, and Scott, you say, never mind, you probably figured it out. Yep. But it's still important for me to lay this out so that everybody understands what exactly the trader's getting themselves into here. Okay. Yeah. So let's just assume we let this go to expiration. Both contracts are in the money. We exercise our right. The other party assigns their right to buy the shares from us. So we buy the shares at $49. We're required to sell those shares for $50. That would be a $1 profit if this were a free trade. It's not a free trade. It cost us 63 cents. Between the $2.13 spent and the $1.50 collected, 63 cents to set this trade up. That's our 37-cent profit. So that's the best case outcome. And obviously, I'm leaving commissions out of this discussion. You might say, Cameron, aren't the commissions going to wipe out this potential reward? No, they're not going to wipe out the potential reward, but they are going to have a small but significant impact on that reward potential. If $37 is the most we could make on a commission-free trade, what would the actual maximum gain be once we've accounted for commissions? Well, it's 65 cents per contract. That's $1.30 to get in and get out on both sides of the contract. So we're doing two contracts here, two contracts getting in, we get out, we got to subtract 260. In any case, oh, that's if we're exiting early. Anyway, we got to account for $1 or $2 in commissions. So that's going to chip away at that a bit. We can't ignore it. It exists. It'll actually show up on our trade confirmation screen. Okay. There we go. There's our maximum risk. We could lose it all. There's our maximum reward. We now understand if these contracts are signed, that's how much we can make. Where might we make and lose the money? Chuck says, which is better, long call or short put vertical? It's a great question, Chuck. I have a suggestion for you. Let me go to our Trader Talks channel here. So if you haven't done this already, make sure that you've subscribed to our channel. You can go down the lower right-hand corner, click on the subscribe button. It doesn't cost anything. It only takes a second. But the Trader Talks Schwab Coaching webcast channel on YouTube is where we house our previous webcasts under our playlists right here. And I've actually done a weighing of the pros and the cons of a credit spread versus a debit spread. So let's just type in here as a keyword, credit, debit. And if I click on this, you'll see options vertical showdown, trade a credit or debit spread, because it's a big question. To me, for me to really do it justice, it takes me 45 minutes to weigh the pros and the cons. But I'm going to bottom line it for you. There's almost no difference if we're using the same strikes. If we're doing credit spreads over 100 trades versus debit spreads on 100 trades on the same security, same expiration, same strikes, it's going to work out pretty close to the same, profitable or whether we net a loss. Okay, that's sort of a spoiler alert. This takes me 45 minutes to explain. They're almost identical, not exactly identical, but almost identical. Yeah. Okay, but let's go back to our trade. And I want to just lay out for the trader the conditions under which they would be looking at losing money and the conditions under which they would be looking at their maximum gain. So I'm going to clean up my chart a little bit. Let's right click here and let's clear up our drawing set. And instead, I'm going to draw the two lines that you're all familiar with. If you're wondering where those pretty lines and boxes came from, where I was going through our existing trades, I just draw them on the chart. Oh, Mighty Mouse, you asked a good question. I need to park your question there. Mighty Mouse says, is a $2 wide more profitable? $2 wide spread more profitable? It does carry more profit potential, but guess what it carries even more of? More risk. Yep. So in the interest of keeping the risk and the investment to a minimum for this discussion, I went with a $1 wide spread. But let's draw in a line here at $50. Did I get that right exactly on 50? That's pretty good. And let's draw in a second line down here at $49 to represent our two contracts. I'm not going to get exactly 49. I'm just going to get as close as I can. If you ever draw in a line and you want to make it exact, just right click on it, edit the properties, and change it to 49 and 49. And how about we make sure that this starts today and ends on the 10th. This one. Let's have it in on the 10th as well, because that's when our contracts expire. In any case, there are our 2 strikes. And the preference for the trader is for this to do this, to go up. As we hit expiration, as long as we're above 50, what happens? Well, if the stock is worth more than $50 and someone has the right to buy it from us for 50, they're getting a discount. So they're probably going to buy it for 50. Only very rare exceptions to that rule. All right. So they buy the shares at 50 and we think, oh no. Oh yeah. That's right. We have the right to buy the shares for 49. So we exercise our right to buy at 49. We sell for 50. We make a buck, subtract out the cost to set up the trade, and we net our $37 minus commissions. Okay. This is what we do not want to have happen. If the stock collapses and we hit expiration, well, this trader is going to say, Cameron, keep your cruddy stock. And we decide not even to buy it. So the contracts just expire worthless. And we lost our investment if we're down below our lower strike. Now, there's a third possibility if we allow this to get to expiration. What if we go in between our strikes? Let's say we're at 49.5, 49.50. The trader who has the right to buy the shares from us at $50, they don't want to overpay. So they say, nope, not buying it. And they leave us with their $1.50. We say, hey, we're getting a 50-cent discount. We can buy shares for 49 that are worth 49.5. And even if we don't want to, if we let this get to expiration, it'll happen on our behalf. The contract is automatically exercised at expiration. We buy the shares at 49. They're worth 49.50. Awesome. Applaud ourselves. We have a 50-cent unrealized gain on the stock, but it cost us 63 cents to set this trade up in the first place. So in that scenario, we'd be underwater a little bit. But the important thing there is we now be owners of shares for better or for worse going forward. And if the trader doesn't want to spend $4,900, maybe they want to get out before that happens. Okay. If they're trying to keep expenses to a minimum in the small portfolio, yeah, keeping an eye on the trade and exiting before expiration, that might be a high priority. So those are a few potential outcomes here. We now know how we might make our maximum, let's highlight the right thing, make our maximum gain. We know how we might incur our maximum loss. We know what else could happen. We could wind up buying the shares when that wasn't the trader's intent. So let's build our trade, but put in a couple of exit orders, take profits or take losses. So I'm going to go to the trade tab. And I do want to go back to the quick question here. Mighty Mouse says, what if we went $2 wide? Well, then we'd have let's say we bought the $48 call and sold the 50. Well, we'd have the right to buy shares at 48 and the obligation to sell at 50. If that happened, that would be a $2 profit. Sounds good if it were a free trade. No, that would actually be a more expensive trade. And instead of spending what did we spend? $213? Theoretically, we're spending more. So the cost goes up. So the cost goes up, the profit potential goes up, but in the interest of keeping the cost lower, I'm going to go with the narrower spread. All right. In any case, let's place our trade, 49.50. I'm going to come up here where it says spread single and change that to a vertical spread. So this is pairing up the strikes with each other. And I'm going to go to that 49.50 strike pairing and click on the ask price. And that's going to create an order to buy this vertical spread. Again, here the trader might decide how much they actually want to invest. Let's just make it as small as we can. Let's just go for one contract. Just really emphasizing the theme for today. But let's say we're willing to spend that 63 cents that we originally calculated. But I want to put a plan in place to take profits or to hopefully minimize losses. Let's see, what was this question? The stock keeps going higher. Would it be a good idea to just close the short call and keep the long call? Well, that would potentially realize a gain on the short call. But if the stock reversed course that long call would be exposed to risk as well. So yes, it would be a good idea if the stock kept going up and we kept making money, but that's a big if. All right. But in any case, let's go to our advanced order here. And instead of just placing a single order, we're going to put in 3 orders. And I'm going to choose first triggers OCO. This is going to allow us to put in two additional orders, one to take profits, the second to take losses. So the first one, well, actually to create those orders, I'm going to right click on the original order and create an opposite order to get out. Right click on the original order, create an opposite order to get out. Okay. So we have an order to enter and 2 orders to exit under different conditions. So let's detail those conditions. If we know that we can make up to 37 cents, let's say the trader would be happy to make even a good fraction of that. Let's say if we could get out and make at least 80% of the 37 cents. Let's do some math here. If 37 cents is the most this trade can make, and let's say the trader is willing to, let's just take profits if we even get a good portion of that, let's multiply 37 by 0.8. So if we were able to sell for it or close out for a 30-cent profit, let's take those gains. So if we're buying in at 63 cents and we close out at 93 cents, hey, that would be a 30-cent profit. I'm going to leave that as a limit order. That's the least we want to sell for. That's our limit. Good till canceled. Now, on the opposite end of the spectrum, if the stock is misbehaving, maybe the vertical isn't working out, maybe the trader doesn't really want to lose all of the 63 cents. What if they want to cut that by half? Well, half of 63 is going to be around 32 or 31. Let's put in a stop. How about we say 32 cents? Stop the bleeding. This trade's going the wrong direction. I want out. So here we are getting in for 63 cents, hopefully 63 cents or less. We'll take profits if we can get 93 cents or more, or we're going to cut our losses down there at 32 cents. That's where our stop trigger is going to be. But as we already learned today, a trigger is not a guarantee of an execution price. We could stop out at a different price, but let's click confirm and send. Going to buy just one vertical spread for 63 cents, sell that for 93 cents if we can, or trigger a stop at 32. Due to potentially wide market or liquidity risks at the time of activation of the stop, that order may be manually substituted with a limit order upon activation and worked until filled. And please note that we have selected a weekly option series as a non-standard expiration date. Yeah, it's the 10th of October, not third Friday of October. There are commissions that can chip away at the potential gain of the trade or add to the potential loss. So Jerry asks a good question. Why not a stop limit? Jerry, I don't have time to get deeply into that today. There are pros and cons to that, though. Not all pros. People tend to think, oh, stop limits, aren't they superior? No, they're different than a stop. They have potential advantages, but also expose the trader to potential additional risks. Okay, but let's click send. And let's see if we can get that thing filled. Go to our working order. We're offering to pay 63. The market price was 63, and we filled at 63. So there, we've put all of this into practice. Guys, we've accomplished what I set out to do today. I wanted to talk through trading vertical spreads in a smaller account. I mentioned, though, that Barb has a webcast. If you're interested in this as a topic, I only did one. Barb has a whole series of these. So first of all, make sure that you're subscribed to our Trader Talks channel. You can go down in the lower right-hand corner, click on the subscribe button, or click on the subscribe down below the video stream. That'll subscribe you to the channel, but you can find our previous webcasts under playlists right here. If I click on playlists, I can go right to the bottom. Barb's is going to be like third row up from the bottom. It's going to be right there. Trading a smaller account. And you can just click on view full playlists, and she has an excellent list of webcasts with a whole range of different strategies that might be applied there. Another thing that I would strongly suggest you do is to follow me and Barb on X. If you have an account on X, it's the best place to connect with your favorite presenters. Barb and I are both very active there. If you reply to one of my posts on X, I try to reply right back to you. So you can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And so, for example, I like to just communicate with my followers, asking questions about the markets, getting their input, having little discussions there. So, for example, I said, the three most common stock chart indicators are moving averages, RSI, and MACD. What is your number one go-to chart tool? And just allowing people to reply, give me that sort of input. It's a great place to have those sorts of discussions. I can also put up, market observations about what's happening with the S&P, that sort of thing. But in any case, take advantage of all of your resources here at Schwab. Now, also, I want to say thank you to everybody that's already clicked the like button. 187 people watching, 64 have already clicked that like button. That's fantastic. It shows your appreciation to your presenter. It also gives my webcast a little boost in the YouTube algorithm. Every time somebody clicks on that like button, it tells YouTube, people like this stuff. Show it to more people. So it helps more people find these webcasts and learn about strategies for like trading in a small account. All right, everybody, thanks for giving me your time today. Barb, thanks for helping out. Very much appreciated. I will see you all in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.